All right, we're live. We're live here at the Constructive House, and sure everybody has gotten the title by now. How lenders approve mortgages, and it's based on your income, assets, credit, and property, and that's how you'll be able to get home approval or denial. Is going to be based on four key parts. Lenders look at your income, and most important, they're looking at your debt to income, and that's where your qualification around income is. I know I've dealt with a lot of mortgage applications, and some do feel that if you earn a certain amount of money, that should automatically just get you a house. And unfortunately, that's not the case. It is based on your debt to income ratios, which is your total monthly obligations. It's a monthly calculation they look at. But your total monthly obligations, that's including the proposed house payment, that'll be thrown in there as well as any other obligations or expenses you have on your credit report. That could be your credit cards, your auto loans, a furniture account, personal loans, home equity line of credit. There also may be some who use like any revolving debt that's reported or not reported, but that you're obligated to will be included. Any child support, alimony, those will also be included. So it is imperative that you inform your mortgage loan officer of any obligations you have that also are not on your credit report, but student loans as well, any fixed installment loans, revolving debt, and mortgage payments, any secured debt. Those are all included in your total obligations, or as I like to say, what's going out the door. What's going out the door, and your gross income, that's what you get before taxes and deduction. That's what's measured as far as your income. So it's debt to income ratio. So it's your total monthly obligations as it compares to your total income that's coming in. And in some cases, you can also use alimony and child support as income if that's going to continue for 3 or more years. Most banks are looking for a continuance of 3 years. Another source of income would be passive income, such as income that you may get from Social Security or disability, like VA disability. Also, income that you may get from annuities, stocks, bonds. That type of income can be utilized as well. Again, you do want to be able to show and tell that you have a 3 year continuance. And now that's my summary of the debt to income ratio. However, I did want to show and share with you all what Fannie Mae has as well. So, anytime you have any questions about guidelines and approval, first things first, keep in mind that mortgage lenders are looking at income, property, assets, and credit. That's how you complete a uniform residential loan application. It's going to be based on, of course, your contact information, but as far as approval, they're looking at your DTI, your LTV, your assets, as far as reserves, what you have as far as any ownership stake, and also your credit. And you need all four. So having phenomenal credit but risky DTI isn't going to help. Having phenomenal equity in the home, but your credit is poor, your DTI is very high, that won't help. So you want to make sure you have all pieces of the puzzle. And I did want to share with you as far as kicking things off with income, what debt to income is explained by Fannie Mae. I'll take a look at FHA as well because they do have different guidelines as it pertains to the debt to income ratio, what they allow. But Fannie Mae, and you can go on fanniemae.com as you see here. Fannie Mae says the DTI ratios consist of two components: total monthly obligations, which include the qualifying payment for the subject mortgage loan. So if you're doing a refinance, it's going to include whatever that new payment or proposed payment will be on the home, and other long term and significant short term monthly debts. It also is composed of total monthly income of all borrowers to the extent the income is used to qualify for the mortgage. So again, the two components: your total monthly obligations, which is debt, and your income. So you have a co-borrower, a co-signer, their income will be included as well. Any qualified income. Like I said, it can't be income you're getting paid under the table. So you may cut mow lawns or do hair on the side. That income can be used, but it must be reflecting on your tax returns. Since it's not traditional pay stub W 2 income, you'd have to file that income on your tax returns in order to use it, in order for it to be qualified income. So we do want to break that down. So if you are a self employed borrower and you're looking to find a home, because in my several years of experience in doing mortgage applications, one of the biggest challenges at times when it comes to DTI is my self employed borrowers. And a lot of times, and I get it, in order to pay less taxes, you'll show less income on your tax returns. The only thing about that is when you're paying less taxes and showing less income, the banks are only able to use the income reported on your tax returns. Typically, when you're filing your Schedule C, it's going to be line 31 that shows net income. That's the income that most banks are looking at, and mortgage companies. That's what they're looking at when they're reviewing your tax returns. So if you show a low amount of income so you can get a refund or so you can pay less taxes, that can come back and be a challenge when it comes to qualifying on the income side. Your debt to income ratios will reflect that income. So if you only report that you made $8,000 for the whole year, then that's the income that mortgage companies are going to have to use as it pertains to qualifying you on debt to income. Now, when that can be a challenge and will be a challenge if it's $8,000, let's face it, because that's the only amount of income they're able to use for you for that year. Now, most times it's going to be a 2 year look back on your tax returns and the average of those. But like I said, you want to look at Schedule C. Line 31 is typically where you're going to see that net income, and that's going to be that determining factor in most cases. Yeah, there are crafty ways where you can add back income based on mileage and things of that sort, but keep in mind, if you are reporting a low amount of income to pay less taxes or no taxes, that can be a challenge when it comes time to purchasing a home. So when you're going in to do your taxes, make sure you do keep your tax preparer or bookkeeper aware of that if you are looking to buy a home, because it can be a challenge at times. Or make sure that your co-signer, it does show the qualifying income so that you can buy the home. And that's what we're going to go over as it pertains to income, is what income, how you can be qualified or approved as it pertains to debt to income ratio. So for Fannie Mae, a solid debt to income ratio, well, for either guidelines, a solid one is going to be any DTI under 43 or 45%. You want to be as far under 43% as you can, meaning your gross monthly income is right here. You don't want any more than 43% of it going out the door to bills. Now, the bills that are not included are, your grocery, gas, car insurance, those types of bills, Netflix bills, those won't be included. It's just your obligations as far as credit cards, which is revolving debt. Any revolving debt that's reported on your credit report, any installment debt reported like student loans, mortgages, um, personal loans that you may take out, auto loans, those type of installment debts are included. All right. So make sure you're always brushing up on what's on your credit report, making sure the monthly payments are accurate. There's a lot of tools out now where you can stay on top of it. There's plenty of credit trackers, Credit Karma. Most banks have all these things where you can stay on top of how much is going out each month. And you can do a simple calculation. You're going to divide your debt and your income, and that'll determine that percentage. As a matter of fact, let me stop sharing this for a second just to pull up a quick calculation. Let me see if I can pull that up. So you can see it in real time and in real life, because sometimes saying it isn't always the best. Sometimes you want to see it, right? So let me see if I can share my calculator real quick. I should be able to. I'm not sure. Um, yeah. See if I can share that. All right. So let's say you make, well, let's say your total of your car, your auto loan, your student loans, your credit cards, all your monthly obligations, maybe you got a boat loan or what have you. Let's say that totals up to about 20, along with your house. Let's say that totals up to about 2,800. All right, that's your total debt. That's what's going out the door to credit obligations. All right. Now let's say you make $6,000 a month. You're gonna divide your debt to income. That's 6,000. All right. You're at 46%. You're at 46%. So you're above 43%. Now, keep in mind, if I was working with a loan applicant and they're at 46%, I would move forward with taking the application and working on approval, because there are a lot of guidelines. That's why it's four pieces: income, property, assets, and credit. If you have stronger credit, then we can get you pushed through on a 46%. If you got a lot of equity in the house, on the property side, we can push that through. As far as your assets, let's say you have 3 to 6 months worth of mortgage payments in the bank, which they call that reserves. All right. So say your mortgage payment is $2,000 a month. All right. You multiply that by six, that's $12,000. So you have 6 months of reserves in the bank. All right. Meaning if something happened, you'd be able to make your mortgage payment for at least 6 months minimum, because you have that in the bank. So things like that can make your profile stronger, as to where the debt to income being at 46, which is pretty borderline, may not be as much of a problem, because you have other strong compensating factors. All right. And FHA a lot of times will allow you to go up to 55%. However, you would be deemed a more riskier applicant. So you may not get the more favorable terms at times, as far as certain guidelines, but I've done applications at 55. I've even done 60%. Back in the HARP days, there was applicants that were over 100%. I mean, they were struggling, underwater, everything. But those loans were there to help those applicants. But we're looking for more. This is more of a foundation course for those first time home buyers, for those first time doing a refinance, those who are wanting to get more information, just general mortgage knowledge. This is to help and be a foundation course for you. But back to debt to income, let's say that the total obligations you're spending a month is $2,500, right? And you make 7,200 a month. All right, you're going to divide 2,500 by 7,200. All right, your debt to income is 34%. All right, so you're good in the income area there. Okay, now let's say you are a self-employed borrower and you reported your taxable income for the last 2 years was at, let's say, 32,000, and then the year before that it was 29,000. All right, we're going to add those together. Then we're going to divide them by 2. Again, remember, we're referencing line 31, your net income on your tax returns. All right, so your taxable income that would be used for qualifications would be 30,500. Now we're going to divide that by 12. All right, because there's 12 months in a year. Keep in mind, debt to income is based on your monthly gross monthly income, GMI, gross monthly income. All right, so the usable income will be $2,541 a month. All right, so keep in mind, your output needs to be less than half of what you're bringing in. So you're going to have to find a very lower housing payment, and you're going to need very little bills that are going out each month, or you're going to need to bring in a spouse or family member as a co-signer, a co-borrower for the loan, so you can add more income. Okay. Now, where this can be a benefit is if you're working a more traditional job and you also have a, as you would say, side hustle. Say you do hair on the weekends, you landscape, cut yards on the weekends. Maybe you get paid for being a pastor or speaking engagements. Um, it could be a host of things. Maybe you do taxes on the side. So that's where it can be an incentive. However, if you are a self-employed borrower, then you need to be aware of these things. Now, there are portfolio loans that come directly from the bank that aren't sponsored by Fannie Mae or FHA or USDA. The bank can directly give you those, and those are based on reserves. So you may show on paper you only are making this amount, but maybe your bank account, you have $80,000 in the bank or $90,000. Then a bank may actually do a different type of program, which we won't be getting into now because, again, this is a foundation course. But don't be discouraged if you're self employed and you're showing a lower amount, because there are alternatives if you do have reserves in the bank. Okay. But if you don't have those reserves in the bank and you are showing a low amount, then it can be a challenge to get approved because it is your qualified income is what's going to be used. And if on paper you're saying you're only making $2,541 a month, and as we all know, if you're looking at houses now, a lot of your minimum mortgage payments are almost 3 grand monthly, 2,900, 3,200. I was helping a friend of mine not too long ago. His mortgage payment is going to be $4,200 for a 3-2 in Alabama. And I'm trying to remember what city it was in Alabama. It's over there where NASA's at. Anyone in Alabama reference that for me? But $4,200. So if he's showing this on his tax returns and he doesn't qualify debt to income wise, and it can be quite the challenge to get approved. But again, we go back, it's income, property, assets, and credit that's needed. Okay. So having an 800 credit score alone is not going to get you the keys to that house. You may have an 800 credit score, but if you make $2,000 a month and the mortgage payment is proposed at 3,000, you're going to be rejected for the loan. Like, we're going to be realistic. We're going to be realistic. Okay. That's one thing I don't want anyone to feel, is that you've been misled. So we're going to go over mortgage tips and some of the ways you can get around certain things, but there's certain stuff you can't get around. All right. I don't want it to be misunderstood there. So just to break it down once more, if your monthly obligations are $2,500, that's including student loan payments. That's including auto loans. If you have more than one, however many, that's including any other revolving debt. That could be your home equity line of credit, credit cards, Amex, American Express accounts, Diners Club, whichever you're using. Those are all factored in. Keep in mind, if you're paying alimony or child support, that also needs to be disclosed because it may not be on your credit report. But once we're going into the loan application process, that will be pulled up. That will be pulled up and it will be included. So it's best to go ahead and unveil all of that up front so you can actually know where you stand while you're going through the application. But if all of those obligations a month, including your proposed house payment, whether that's a refinance payment or whether you're looking to buy a home and you're going over what that new house payment will be, that all needs to be included in those monthly obligations. And you're going to divide that by however much your gross monthly income is. So let's say you're making $6,000 a month. That's around a $60,000 a year income, which is pretty average for most Americans out here. All right. Now keep in mind, if a husband and wife both are making 60,000, that's 120,000 of qualified income you could be using. So keep that in mind. All right. Now that would bring your debt to income at 41.6 or 41.6%. All right. So it's not bad. It's not bad. You wouldn't be considered risky when you're getting your loan application submitted to Fannie Mae or Freddie Mac through the desktop underwriter. However, you are pretty borderline. So if things are close, and by close I mean, like, let's say you're looking to buy, you're competing for a home, you're bidding on a home, and let's say the other borrowers, potential buyers, are raising the price, then you can be a little restricted as far as how much more you can go up in price, because then you'll start being more risky on that debt to income ratio. Okay, so keep that in mind. The closer you are to 45%, the closer you are to being considered risky. Anything over 45%, even if it's FHA, is still viewed a little riskier on your income profile. It is. It just is. Can you get approved for those loans? Yes. And I'm sure there's some of you out here now saying, "Oh, I've done a loan at 50% debt to income." Yeah, you can do that. FHA will permit that for sure. They'll push that loan through. It can still get approved, especially if you have other strong compensating factors like a 680 credit score or higher. You're making a sizable down payment. You have 3 to 6 months reserves in the bank. Yeah, those things will get you approved. But keep in mind, we're right now we're focusing on income. Okay, on income, debt to income ratios, and anything over 45% would be considered riskier. All right, so keep that in mind. And let me stop sharing this real quick. So I hope that's making things easy as it pertains to debt to income qualifications. Like I said, I did want to go over. Let's see what FHA has to say about it. Let's take a look. Let's see what FHA has to say about it. Do I want to go on? Let's go here. Let's take a look here. All right. So the FHA debt to income ratio is a measure used by the Federal Housing Administration to determine if borrowers are financially qualified for an FHA loan. This ratio calculates the percentage of a borrower's monthly income that goes towards paying off debts, including housing expenses. If you've spoken with a lender, they may have talked to you about your debt to income ratio because it is the primary method of determining how much you qualify for. Again, the income portion of the application, the what lenders and banks are looking for is your DTI ratio, and this is something you can calculate at home. You could be at work. I mean, we'll go through Facebook, we'll go on Instagram, we'll go on YouTube. You can literally pull up your calculator, type in, I mean, you can pull up your phone, look at how much credit bills you have, pull out your calculator, put that total amount in there. Credit Karma breaks it down. A lot of them break it down how much your monthly bills are on your credit report. Put that in your calculator, divide it by your gross monthly income. You can pull up your paycheck as well to see that. You put it in there, that's your DTI. Boom, you know what it is. You can see that percentage. All right. The FHA guidelines allow for a DTI of 43%. However, much higher ratios of up to 56.9% are allowed with compensating factors. These FHA DTI limits are more flexible than conventional loans. So FHA is a lot more flexible when it comes to DTI than you're going to see on a conventional loan like a Fannie Mae or Freddie Mac loan. And again, I have another video out there about the difference between Fannie Mae, Freddie Mac, and a government loan like an FHA loan or VA loan. All right, Fannie Mae and Freddie Mac are government sponsored agencies. They're not the government, but they're government sponsored agencies that have set guidelines for banks to follow. That way, banks, all of their loans that they're sending out that are approved by the guidelines of Fannie Mae or Freddie Mac, the bank will then be able to have that loan bought off the secondary market, which allows them to lend more loans to borrowers, get more homeowners. That's the whole objective, is to get as many homeowners as possible. So if the loan is approved by Fannie Mae or Freddie Mac, the bank can then sell that loan in the secondary market, and they'll be able to get more money to lend out to more homeowners. The same for government agency loans, the same concept, except the regulations are from the government. The Federal Housing Administration has their regulations, and the Veterans Administration has their regulations, and they're going through the same process. As long as the bank is following those guidelines, they'll buy those loans in the secondary market, and that's where the banks get more money to lend out. That's where it comes from. You don't have $500,000 in the bank. You go to get a loan for the 500,000. That loan is called a mortgage, and that's how you pay to buy the house. You make small payments, monthly payments, until you pay that loan off. That's how it works. In order for the banks to give you the money, they do need to have those mortgages qualified, clean, closable loans. They need to be qualified in order for them to be purchased on the secondary market. When they're purchased, then they can give out more money. So that way, when you don't have $300,000 to buy a house, the bank can lend you that. That's how they're able to lend that. This is a little tidbit of information for you there. But I'm going back to FHA and how to calculate FHA DTI. All right. When calculating the FHA debt to income ratio, you'll start with your gross monthly income. Like I said, you can go right on your calculator, right on your pay stub. I'm sorry. And you can see how much you make before taxes come out. It says it on your pay stub, gross monthly income. Now, if you're self-employed, you're going to be looking at your tax returns. And we can't use your gross monthly income. We got to use the net income that's shown on line 31. All right. However, let's get back to it. Then you'll add up all your required monthly payments that appear on your credit report. You see? This includes credit card minimum payments, car payments, personal loans, and other mortgages like a home equity line of credit, any second loans, construction loans that are put on your credit, anything that's put as another lien or loan against the house. Those all need to be factored in. Student loans as well. The only exception would be student loans since they are handled different. FHA does handle student loans a little different. So let me retract that. Student loans are required and included on conventional loans, but student loans are handled differently when it comes to FHA loans. That is correct. All right, here is an example of a debt to income ratio calculator. You can also use your DTI calculator provided at this article. You don't need to use theirs. You can use the one you have right on your phone. This isn't rocket science. This is constructive house science. You need to be able to be sufficient on your own and know how to utilize what's already right there in your face. Like I said, if we can go on social media and look up all sorts of non-constructive things, there's no problem. We're hopping on your calculator and just seeing it what your DTI is. These are things you should know whether you are or are not applying for a mortgage. You need to know how much of your money's going out versus what's coming in. You need to know that. I hear a lot of people say they're saving to get a house and they don't even know what their DTI is. Well, how do you know you're saving the right amount? How do you even know that you're able to get a house based on your income? You don't. So, gross monthly income, let's say it's $6,200, and the total of your debt obligations is 2,590. Your back end, which is your total income, debt to income ratio, is 41.7%. All right. Now, keep in mind, and this is a good tip here. When shopping for a home, the property taxes will have a significant impact on your DTI because that is included as well. Your taxes and insurance are included in what's called your proposed housing payment. So whatever your property taxes are and whatever your home insurance is will be included. Now, I've worked with a lot of different clients, and they'll say, well, I don't pay my taxes monthly, I pay them per year. Look here. The lenders you're talking to, the mortgage loan officers you're talking to are more than aware that your taxes are not typically paid every month. However, when you have an escrow account, they do collect for it every month to ensure that what's needed when it's due is there. Okay. So just to pull up our calculator again, so you can take a look here and see what's going on. What you'll do is whatever your annual taxes are, the proposed taxes, whatever your insurance is, whatever that amount is, you'll need to divide it by 12. Okay. So let's see. Let's pull this up again here because we want to break this down with you. And I'm going to be taking my time, but we're going to break it down. All right. So let's say your property taxes are 3,200 a year, right? Better yet, how about we do this? How about we do this? Because I like to make it look as real as it can be. All right. So we're actually going to do this. All right. Let's pick a house, any house. I'm going to pick any house. All right. Um, where I want to go? We'll go Jacksonville. We've been talking a lot about Jacksonville. Let's go to Jacksonville. All right. So let's pick up this house, 4 bed, 2 bath. All right, let's see what the taxes are. Well, it should show you that here. I may have missed it. Bear with me. Property details, yeah. Okay, Melon. Taxes. Here we go. So you go under property history. I like to use realtor.com. You can use Zillow as well. But you go under property history. You see the taxes here are $4,091. That was based on 2023. All right. So you're going to divide that. What was it again? 4,091. Divide that amount by 12. So you'll need roughly $341 to be included in that house payment. You need to add that to your debt to income because that's what mortgage lenders are going to be using. They're going to add all of that in there. All right. Same with your insurance, your homeowner's insurance. So if your annual homeowner's insurance is $800, then you need to be putting in $67 into your debt to income. This is how you ensure that you're prepared. This is also your ammunition in case you're dealing with a loan officer that is giving you misinformation. You can let them know, hey, I did my own DTI calculation and this is what I have. Can you show me what you're using? And this also helps you with that understanding because the goal here is for mortgage literacy. Okay. We do want everyone to be able to be literate when it comes to mortgage. But when you're looking at homes while you're dreaming away, as you should be, and you're putting these on your to do lists and your dream boards, go down here and look at these taxes. All right. See how much the taxes are in the house. Don't just look at the pictures of the home and say, this is what I want. That's one part of it. All right. Because keep in mind, the mortgage lenders, the banks are looking at your income, property, assets, and credit when it comes to completing your mortgage application and whether you're going to be approved or rejected. Okay. Now, a tidbit, just some tips, and we'll move on to the property side. Keep in mind total monthly obligations, including the housing payment, and that's property taxes and insurance divided by your gross monthly income. If you're applying with a spouse or a loved one, you need to have their information as well. That's their total obligations as well as their gross monthly income. That needs to be included to get your total DTI, debt to income ratio. Again, you want to ensure that debt to income ratio is lower than 45%. I know FHA will allow you to go up to 56.9. It will if you have other compensating factors, but you don't want to be right on the cusp. You don't want to be on the spectrum. You want it to be as low as possible. It's a measurement of what you have coming in versus what's going out.